Hello, everybody. This is AK. I'm back. Life is so unpredictable. Here I am making another YouTube video. Didn't expect this, right? But well, I was crossing fingers that I would get my buy order for Wilmar International filled today, and well, I'm happy it got filled, which means another blog post, another video. So earlier today at 2 p.m., I published a blog post on how my overnight buy order, right, my buy order for Wilmar at $3 per share was filled. And was just an update, right? Many people were asking me the entire year, because Wilmar share price has come down by some 15% this year. And many people kept asking me if I was buying, and at $3.20 people asked, at $3.10 people asked, and I kept saying I was waiting to buy at $3 per share. It's a natural support, a strong support, and at that price, historically I see the insiders buying, and then Wilmar also does share buybacks, and briefly in August, it was at around almost $3, I think it was $3.01. So my queue wasn't filled, right? But finally, today at $3 per share, my queue was filled, right? So I added to my position in Wilmar International. And if you have been following me for a long time, you know that Wilmar International is very undervalued. If we look at the sum of its parts, right? Its majority held business in China, YKA, right, has a larger market cap than Wilmar in Singapore. And Wilmar still holds 90% stake in YKA, if I remember correctly. So if we buy Wilmar today, we buy Wilmar's common stock today, we are getting most of its businesses for free, right? And this is something I've said for a long time. So if you wonder why, insiders were buying Wilmar at even higher prices, and I think Mr. Kwok was buying Wilmar stocks at even like $3.50, $3.60 per share, when the share prices were much higher than it is today. He was still buying because even at those prices, Wilmar is undervalued, right? You'll be getting most of its businesses for free, right? And at lower prices, I'm sure they'll buy even more. Insiders will buy even more, right? But of course, like I've said before, a stock could stay undervalued for a long time, right? And but there's no accounting for price. I mean, Mr. Market will do what Mr. Market will do. There's no accounting for Mr. Market's emotions, right? Undervalued can stay undervalued for a long time. Overvalued can stay overvalued for a long time, right? And it's right now, I think it's a good opportunity, at least for me, to add to my investment in Wilmar, right? Wilmar's business in China is not performing as well as before, and that's why the share price is being punished. And because of this, I have an opportunity to buy on the cheap, right? Chinese economy is still suffering from the meltdown of its property sector. The consumers are still cautious, and they are not spending as freely as before, right? This one we know is all over the news, and it's true. I mean, some people say, oh, it's fake news, but if we look at Wilmar's performance, we'll know that the news is true, right? It's not fake news, right? The Chinese consumers are tightening their belts. So unless we feel that China will never recover, right? We feel that way, then don't buy, right? But I think that China will recover. They will pull out all the plugs, and they will make sure that the economy recovers, right? So by March, we will know what kind of measures they are going to have in place. Already there are clues that there's going to be quite aggressive stimulus But we'll know the details, I think, by March, right? When they have a big meeting, right, of the top decision makers, if I remember correctly, right? And I think the downside is probably limited, right, for Wilmar right now. But that's just what I think, lah. And I also like the fact that Wilmar has been consistently paying dividends, right, through good and bad times, right. During the pandemic, they did not suspend dividends; they were still paying dividends, and meaningful dividends, right. And a dividend per share, I think, of 17 cents, which is something we have seen in the last couple of years. 17 cents dividend per share per year isn't demanding, right? Because it can easily do that with its earnings, and earnings is expected to come in at about 30 cents in 2025. So if we pay $3 per share for Wilmar, we get a dividend yield of like 5.66%, and the earnings yield is about 10%. That's not too shabby, right? And of course, if you have been listening to me talking to myself about the banks, you know what earnings yield is and how it is more important than just looking at dividend yield, right? It gives the complete picture, right? And that's Wilmar, right? The next thing I want to talk about is Alibaba. Suddenly I keep talking about Alibaba. That's because my last video on Alibaba left many people with questions, right? All the question marks appearing above their head, right? Many regular readers and viewers were curious why I invested in Alibaba Group after all the videos I made about Alibaba. But in those videos, I did say that Alibaba was trading like a value stock, and that it will get some value investors interested as well. Those value investors who didn't think that China was uninvestable would be interested in investing in Alibaba, right? I said that, right? But I wasn't prepared to jump on the bandwagon because of policy risk in China, right? And I also thought that they were a bit stingy when it comes to dividends. Right, the dividend yield it's like something, I think it's less than 2%, the dividend yield, but it's on a payout ratio of about 20%. So it's a very low payout ratio, so the dividend is definitely sustainable. And Alibaba has a very healthy balance sheet, very healthy cash flow. You can easily pay more in dividends, right? That's why I say, if the dividend yield was like 4%, for example, it would be a more persuasive buy for me, right? But of course, Alibaba, what they've decided to do is to do more share buybacks, which, if you think about it a bit more, isn't that horrible an idea. It's actually quite a good idea, especially when its share prices are so depressed, right? It's buying back its shares on the cheap, and this will lead to earnings accretion, right? So each remaining share in the market will see its earnings per share, see its earnings improve, all else being equal. So that's what called earnings accretion. And because of this, we should see a lower PE ratio. So if you pay $80 80 Hong Kong dollars per share today for Alibaba, it's actually cheaper. It's a better deal than paying 80 Hong Kong dollars per share, say 2 years ago, right? Because there's fewer shares in the market, and there's earnings accretion. But I try to be consistent when I can. There are sometimes I do things out of the ordinary, but if I do things out of the ordinary, you usually have a good reason, right? And Alibaba, right, is going to be a small position in my portfolio, right? Even though I might add to my position in Alibaba, it will remain small, right? And people ask me, oh, you want to add now? At what price would you add? Well, if the price declines another 5% from here, I'll probably add to my position Alibaba. And the entire investment in Alibaba shouldn't form more than like 2 or 3% of my portfolio, right? Simply because as an investor for income, right, it doesn't quite fit the bill, but it's an undervalued a stock, and it's just too attractive to pass up. Once I've decided that I'm willing to take on the policy risk that's in China. Right. So if there's another 5% decline in stock price, if I look at the charts, right, there is a mild uptrend that's forming. There's a very mild uptrend that's forming. If we connect all the lows in its stock price in the past year or so, we can see a uptrending support line, right? And even if there's another 5% decline in share price, that very mild uptrending support line should still be intact, right? So only if the stock price crashes and by more than 5% from here, then that uptrend would be broken. Right, so if the support holds, then we can say the worst could indeed be over for Alibaba. Right, technically speaking, right, the worst could indeed be over for Alibaba. And then if we look at the ratios, the 13 years median PE ratio for Alibaba is about 30 times PE ratio, which means that if Mr. Market comes back to buy Alibaba, Mr. Market decides that it likes Alibaba again, we could see his stock price doubling from here. That means it could double from here. But of course, that's just speculation, right? I wouldn't hold my breath. Undervalued can stay undervalued for a long time, and it certainly seems to be the case for Alibaba. So this is a slightly speculative position, even though it has very strong fundamentals, right? Simply because of China policy risk and how people's attitude is towards Alibaba, most people's attitude, right? So remember, whether stocks or socks, just like Warren Buffett, we like to buy them when they are marked down. Okay, so if AK can talk to himself, so can you. Bye bye.